How's it going out there? Jeremiah Conjure here from Annuity Association, and we're back. We're live, and we're here for another exciting unbiased annuity review. Today, we're going to be discussing the American Equity Estate Shield 10, the American Equity Estate Shield 10 fixed indexed annuity. So this is a very unique product in the sense that it can manage and help someone achieve particular financial objectives. And one of those being increasing lifetime income, as well as some benefits for the overall estate in the form of a death benefit. So if you have some legacy goals, this annuity really shines in regards to that particular objective, but also in regards to the opportunity for increasing lifetime income. So there are some other annuities in this space that are becoming very, very popular. One of those being the Allianz Benefit Control and Athene Agility. So if you're familiar with those two products in the form of offering increasing income potential, this is American Equity's offering to essentially compete with those two products. So if you're looking at either one of those, you definitely want to consider American Equity's Estate Shield 10 in that comparison process. For those not familiar with me and my firm, I'm an independent annuity advisor licensed in all 50 states. And Annuity Association, our foundational mission is to bring more transparency to the annuity buying process and ultimately create a better annuity buying experience. And we do that through transparency, through education, and through ultimately helping you perform and conduct side-by-side comparisons with the various indexed annuities or fixed annuities that may be ideal for helping you achieve your financial objectives. So if you're interested in working with me, I'd be grateful for the opportunity. You can contact me directly on our website at annuityassociation.com. Right there on the main page, click the green button to request your free report. You'll be taken to a series of opt-in questions where you'll be asked if you'd like to be contacted by an advisor. Simply answer yes, and I will personally reach out to you in a timely fashion to see how I can help point you in the right direction. Okay, so let's go ahead and get started. I'm going to start, as always, with our handy-dandy disclaimer, get that legal stuff out of the way, and then we'll dive into the product brochure portion of our review. If this is the first time you're watching, our review process is very simple. We start with a review of the product brochure, and we go through the various why is this thing freezing up on me? We go through the various products and features, benefits, and that type of thing. Shortly after, we'll also be taking a look at the what we call performance analysis, where we'll take an in-depth look at the associated index crediting strategies that can be found in this particular annuity. And then last but not least, once we finish up with that, we'll take a look at a sample illustration to show you how the annuity works and the mechanics behind it and what it looks like, using a ledger. So it looks like my software is freezing up, so just bear with me here while I work through that. That's kind of a first for this. Looks like it might be time for a new laptop. Geez Louise, how embarrassing. Bear with me. I assure you this thing's been working great all day, but you know how it is. If you go and really need something to work when you're needing it to work the most, and you go and really have the pressure that's on. In this case, we're doing a live product review, and we need this disclaimer to come up, and it's not wanting to come up. So let me restart this program real quick. This is, here we go. Are we moving? We're moving. Hold on. I think we're getting somewhere. Thank you for bearing with me through this. All right, so it's wanting to work, but it's not working. Okay, let me let's exit this thing out. Okay, And then now let me open it back up and we'll start fresh. There we go. All right, come on. Come on, baby. Here we go. Okay. So again, we're talking about American Equities Estate Shield 10 Fixed Indexed Annuity. This is an independent review brought to you by AnnuityAssociation.com. This is a review, not a recommendation to buy or sell an annuity. American Equity has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of the respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. Okay, so we made it. We got through that. Thanks for your patience while we work through that technical challenge there with PowerPoint. Okay, so let's go ahead and delve right into the product brochure. So we're talking again about the Estate Shield 10 Fixed Indexed Annuity that's offered by American Equity Investment Life Insurance Company. So for the Estate Shield, every retirement is different with different financial goals and needs. Still, many of today's retirees' objectives are the same, and those are asset protection, growth opportunities, and protected benefits for beneficiaries. Fixed indexed annuities offer benefits that help millions reach their retirement goals through guaranteed principal protection, tax-deferred growth, and opportunities for asset accumulation. So let's first understand what fixed indexed annuities are. A fixed indexed annuity is a contract backed by the financial strength and claims paying ability of the issuing insurance company. This guarantees contract owners a retirement vehicle designed to protect assets while allowing for growth opportunities. It does this through a combination of powerful benefits. First being the principal protection. So you receive a contractual guarantee that your investment amount, or what's referred to as a premium, can never be lost due to market volatility. Fixed indexed annuities can also offer guarantees on lifetime income, tax-deferred growth, liquidity, and they may also avoid probate. So a fixed indexed annuity works simply by understanding that first and foremost, it's a retirement product that's purchased with an insurance provider. In turn, they'll guarantee principal protection, tax-deferred growth on assets, and a reliable income stream. Throughout the course of the contract, the fixed indexed annuity can earn additional interest credits based in part on index increases. As an insurance product, the fixed indexed annuity is not directly tied to any index, so there are none of the exposure risk associated with direct stock or share ownership. The annuity cannot lose money due to index volatility, and the interest credited will never be less than zero. So who's American Equity and why should you consider them in your annuity search? For over 20 years, American Equity has been committed to quality annuity products backed by superior service. Today, as the number 3 all-time fixed indexed annuity provider, American Equity remains focused on the business principles that have served their contract owners from the beginning. Through their financial strength and ongoing stability, American Equity helps fund more than 500,000 contract owners' retirements across the country. So at the time of this brochure being issued, they had approximately $57.6 billion in assets under management, over 26,000 active agents or advisors, 500,000 active contract owners, and they are American owned and operated. They currently hold a A- financial stability rating from AM Best, which is considered excellent. They also hold the same rating through Standard & Poor's and Fitch. So here are the key terms that we'll be using in discussing this particular annuity product. I won't spend much time here because I'll be able to advise on these specific terms throughout the rest of the brochure. The key ones here, though, is this annuity will offer a free withdrawal provision which gives an opportunity each year after the first contract year to take withdrawals up to 10% of the total premiums paid without any expenses or early surrender charges or anything of that nature. There will be a unique account that's called a benefits account, and they refer to it as a benefit account value, which is the value used to calculate lifetime income payments. The initial benefits account value is the initial premium paid plus the benefits account value bonus. So there is a bonus associated with this product. I will be disclosing what that amount is at the time of this review here momentarily, so stay tuned. There will be various interest crediting strategies that are offered in the Estate Shield 10. We'll be covering those. And then there is a unique feature called an enhanced death benefit, which is essentially when the beneficiary may elect to receive the enhanced death benefit in place of the death benefit provided under the base portion of the contract. The beneficiary may have the option to choose to receive the enhanced death benefit as either a single lump sum payment or a series of payments over a period of 5 years. So I'll be talking about that here shortly. And let's keep on moving. So annuity benefits working for your retirement. A fixed indexed annuity offers a powerful combination of benefits that help protect against many of today's common retirement concerns. And according to some surveys, the 5 most common retirement concerns are outliving your income. So the fixed indexed annuity benefits can help secure guaranteed income that can be turned into lifetime paychecks. And next is market volatility. You can protect your principal in all credited interest from downturns and never lose money due to index market volatility. Tax exposure. Money grows tax deferred in a fixed indexed annuity, allowing for faster growth over time until money is withdrawn. And then liquidity, up to 10% free withdrawals annually, plus partial withdrawal options and lifetime income flexibility. And last but not least is legacy planning. By protecting your money and loved ones from the time-consuming and expensive probate process. So again, principal protection, your premium payments are secure, and each year any interest credited to the contract is locked in and cannot be lost due to index volatility. Guaranteed income allows for flexible payout options, which are available, including lifelong paychecks. Tax-deferred growth, earn interest on money without paying taxes on it until any distribution occurs. It enables faster growth by allowing credited interest to compound over time. The liquidity feature allows in each contract, and it defines various opportunities to withdraw funds such as free withdrawals, partial withdrawals, and lifetime income options. And of course, it may avoid probate. If applicable, beneficiaries receive any remaining value in the contract or can elect enhanced death benefit options while avoiding the expense and time spent in probate. So if you don't have a will or trust, which obviously as an advisor, we always say that you should, but in the event you don't, any monies put into an annuity such as this will avoid probate most oftentimes, because in the application and contract, there will be a designated beneficiary section, and the laws in each state, depending on the state, of course, will determine, if there is a beneficiary listed, that's who it would go to. There wouldn't be no need for probate. So probate can be costly and timely. So it's very important to note that benefit. The Estate Shield 10 is a long-term product designed to help provide increasing income while preserving beneficiary benefits. So for premium allocations, which is your investment amount, purchasing an Estate Shield fixed indexed annuity allows you to start growing your lifetime income and beneficiary benefits from the start. On day one, the initial premium payment can be allocated in a combination of fixed interest and index-linked crediting strategies. Throughout year one, you have the option to add more money to your annuity. Any additional premium adds to your benefits account value and boosts your lifetime income and benefit reserves. All payments received after the initial premium automatically go into the fixed interest strategy until the first contract anniversary. Contract anniversaries is when the contract value may be reallocated to a combination of crediting strategies at the contract anniversary or at the end of a 2-year crediting strategy. Allocations are subject to these minimums. $1,000 in regards to minimum allocations, and minimum transfers are 10% of the contract value. All year one premiums receive a benefits account value bonus, which we'll be uncovering what that specific bonus is here momentarily. In addition to just talk for just a brief moment about the contract anniversaries and one of the value adds that we offer our clients here at Annuity Association, and that is when your contract is coming up for an index crediting anniversary, we're going to have a one-on-one meeting on Zoom to get together and discuss, the current performance of your allocated premiums towards the specific index strategies, and also provide an analysis on the other available index strategies for that same time frame, and help you make an educated decision on whether or not we should rebalance those allocations to get the most growth potential moving forward. Obviously, prior performance is not always the best indicator for future performance, but most oftentimes I hear horror stories where someone purchased an annuity and the person that sold them the annuity or was their advisor for the annuity never followed up with them upon contract anniversaries to help them decide whether or not to reallocate the funds in the annuity. And unfortunately, they would have been better reallocating throughout the time of the annuity contract, maybe a 10-year time frame, and they would have gotten more out of that growth potential by doing so. But because their contract was neglected in a sense from the advisor's side of the table, unfortunately, they weren't able to benefit from that growth potential they could have had. So one of the value adds we provide at no charge, if you become a client of our firm and work with me directly, I'm going to ensure that you get the most growth out of your annuity moving forward. So for the benefits account value bonus, any premium you pay year one is established as the benefits account value and receives a bonus. This bonus is available as part of the lifetime income withdrawal reserve after 10 years and as part of the enhanced death benefit option for beneficiaries. And so part of the way that you're able to benefit from the lifetime income portion of this annuity is through the lifetime income benefit rider, which is also referred to as the LIBR. The lifetime income benefit rider is automatically included with this contract. This provides security through a stream of income payments to the owner. Income payments are guaranteed for life, subject to the withdrawal provisions of the rider. It also allows for continued access to contract values and the flexibility to start and stop income payments. In addition, an enhanced death benefit, which may provide a greater benefit than the base contract, is included with the lifetime income benefit rider. Income payments can be used to help build retirement assets into an income stream that cannot be outlived. The Estate Shield has 2 built-in benefits designed to deliver continued benefit growth. And the benefits account value bonus, starting year one, a benefit account value bonus is applied to every dollar paid in the first 12 months. This is an immediate increase to your benefit account value, which is used to calculate lifetime income payments and benefits. The benefit account value multiplier is a unique feature where each year, after any interest credited to the contract value is increased by the benefit account value multiplier. We'll be breaking this down here on the illustration momentarily, so be sure to stay tuned to that. Lifetime income withdrawals can begin after 10 years or can be left to continue to grow for as long as you want. So this particular annuity is going to require that you hold the annuity contract for 10 years before you can begin the lifetime income withdrawal. So it has to defer for 10 years before you are to turn on income. So it's ideal for someone that's approaching their retirement date. Maybe they're within 10 years of that date. That's an ideal time and what we refer to in our industry as the retirement red zone, where during that 10 years, one of the most crucial things that can impact both negatively and positively in regards to someone's retirement success moving forward is what we call the sequence of returns. If we have sequence of returns that are favorable during those 10 years and your money is allocated in the markets and able to benefit from those positive gains, then your outcomes in retirement can be better off, as opposed to if we had unfavorable sequence of returns during those 10 years of time. Obviously then you would have less money to work with. So why it's important to shield, hence the word estate shield, why it's important to shield a portion of your retirement portfolio from unfavorable market sequence of returns. It's to avoid those negative market environments where the returns aren't favorable. By putting them into an annuity that contractually guarantees principal protection and also grows your income benefit account, guaranteed, using some guaranteed rates, as well as some multipliers that can be used if the markets are doing well. It's just a safer way, more conservative approach to ensuring that a portion of your portfolio is going to be shielded and protected, but also giving it some more growth than it may have not received if it was left to the markets and potential unfavorable market returns. So I know I said a lot there. Hope that makes sense. Free withdrawals can start after the first contract year, and you have the option to withdraw up to 10% of the total premiums paid at no expense. So let's talk about the potential for income payment increases. When lifetime income payments begin, payouts can continue to increase with the benefit account value multiplier. The annual income payment amount will be increased by an amount equal to the current annual income payment multiplied by the benefit account value growth rate, which we'll be disclosing here just in a brief moment. They also offer a feature called the well-being benefit, which is a well-being benefit is automatically included with the lifetime income benefit rider at no fee. This allows increases in the income payment by an enhanced income payment factor, 200% for single life, 150% for joint, for a maximum of 5 years. This option is available based on eligibility requirements below, and those are enhanced income waiting period of 10 years has elapsed, the contract value is greater than 0, and the owner or spouse are no longer able to perform 2 out of the 6 activities of daily living, which are also referred to as ADLs. Those are things like walking, continence, feeding yourself, getting up in and out of bed, things of that nature, anything that would classify you or qualify you to be in a long-term care facility. Those would be the same requirements to qualify for the well-being benefit. And what that essentially does is whatever your guaranteed lifetime income amount is at the time of this qualification, the income amount will be doubled. So 200% if the income is structured for single life, or 150 increased by 150% for joint life. Okay, so let's look at some important withdrawal factors based on the market value adjustment index. So if you're not familiar with annuities, one of the terms that is often found in annuity contracts is called a market value adjustment. The market value adjustment will only apply in the event of a cash surrender, which is essentially during that 10-year period of time for the contract. If you decide to walk away or surrender the contract, there may potentially be a market value adjustment that is applied because of you walking away early and not fulfilling the contract commitment, the contract term commitment. So this product contains a market value adjustment rider. A market value adjustment may increase or decrease the amount of a withdrawal in excess of the free withdrawal amount or the surrender value. The market value adjustment does not apply to free withdrawals, any death benefit, the minimum guaranteed surrender value, or any distributions occurring after the surrender charge period has ended. In general, as the market value index increases, cash surrender values decrease. As the market value index decreases, cash surrender values increase. Okay, so moving on to the different options that will be available. So these are the different index crediting strategies and different indices specifically that are offered. It offers a selection of diversified index options. Interest credited to the estate shield is based in part on increases in index returns. Regardless of the index performance, the contract value will never decrease due to index declines. So in the Estate Shield 10, the index options are the Bank of America Destinations Index, which is a multi-asset risk-controlled index, designed obviously in collaboration with Bank of America. This exclusive to American Equity Volatility Control Index aims to deliver stability and growth in changing market conditions. The Credit Suisse Tech Edge Index, which is also a multi-asset risk-controlled index. The Excess Return Index combines 4 U.S. tech and biotech-focused ETFs and 2 fixed income components. It utilizes a cutting-edge target volatility control mechanism powered by SALT Financial to identify changing market conditions by using a combination of intraday and end-of-day data. The S&P 500, which is oftentimes known as the benchmark for the stock market. The index includes 500 leading companies and captures approximately 80% coverage of available market capitalization. It is considered one of the best gauges of large cap U.S. equities and rebalances quarterly. Then you have the S&P 500 Dividend Aristocrats Daily Risk Control 5% Excess Return Index. That's a long one there. This index includes an index and a cash component. The underlying Aristocrats Index includes equally weighted constituents that have followed a policy of consistently increasing dividends every year for at least 25 consecutive years. And then last but not least is the SG Global Sentiment Index. This is a global excess return index that uses 6 cross-asset capital market indicators to assess market sentiment and determine whether the market is in a growth, intermediate, or shrinking phase. Once the market phase is determined, the index allocates assets across a predetermined global and diverse asset base, including ETFs and domestic, European, and Asian indices. So there's a lot going on here. You can get really into the weeds when you start, trying to break all of these indexes down and the methodologies behind them. It's one of the ways that you can get lost essentially by comparing all of the hundreds of different indexes available, but that's where we come into play. I have the ability here at our firm to really show you a comparison analysis and performance analysis of these specified indexes, both present and in the past, to determine what the growth rates could have potentially been if we owned them during the past 10, 15, and 20 years. So if we own this annuity during the last 10, 15, and 20 years, I'll be able to show you what these specific indexes and the index crediting strategies could have potentially performed at if the offerings that are present today were available back then, and give you kind of at least an understanding of what those growth potentials could be if markets perform similarly moving forward, which we'll be taking a look at here momentarily in our performance analysis portion of this review. So in the Estate Shield 10, there is ongoing access to money, including up to 10% free withdrawals annually. Partial withdrawals during the surrender charge period will have a deduction applied according to the surrender charge schedule. So surrender values and charges. The annuity surrender value will never be less than 87.5% of the premium received, less any withdrawals accumulated at the minimum guaranteed interest rate. If a partial withdrawal above the free withdrawal or surrender is taken during the surrender charge period, a deduction will be taken out according to the surrender charge schedule. So surrender charge schedule, again, this only applies if you ever were to exit early before 10 years. After 10 years, there would be no surrender charges or market value adjustments that would apply. You'll see the withdrawal charge schedule applies in year 1 at 9.2% and then starts to decline after year 1, ending up at 1% the final year of the contract, and then obviously in the 11th year at 0. Estate Shield 10 lifetime income payments are available after a 10-year waiting period without a withdrawal charge or having to annuitize the contract. So if you're not familiar with the word annuitize, that is a fancy word for basically the process of, in exchange for your premium, the insurance company will guarantee an income stream, whether it be for a certain period or a lifetime payment. It's the oldest form of receiving lifetime income. Back in the day when annuities were first coming to the markets, in order to receive a lifetime income stream, you'd be required to annuitize your contract, which is the act of giving the insurance company your premium dollars and then receiving that income guarantee for life or for a certain period. Annuitization is very rare these days. Less than 3% of all annuities sold today for income are ever annuitized. Now in these indexed annuities specifically, you never lose control over your premium investment amount even after you turn on lifetime income. So you still have additional liquidity. You still have control over how the monies are allocated to the different index crediting strategies. And it's just a better way of receiving the guarantees for income without giving up control over your premium investment amount. So that's basically what this is saying, is that after 10 years, you can turn on lifetime income payments without a withdrawal charge or having to annuitize the contract. Lifetime income payments can begin on the day after the 10th contract anniversary date or later, and the amount of income available would depend on multiple factors, such as the amount of time the benefit account value grows, age at the time payments begin, and the frequency of payment option chosen. The table below lists the lifetime income payout factors by age for both single and joint lifetime income payments. So essentially for these payout factors, whether you're filing for single life or joint life coverage, the payout rate is what I refer to it as, or the lifetime withdrawal rate, is going to be determined based on the age at the time you elect to turn on income. So after, let's say you're age 50 at the time you purchase this annuity, after 10 years, you're 60. Well, and it was single life, you'd fall into this 3.85% withdrawal rate or payout rate. That payout rate is multiplied by the amount of the income benefit base, or in this case, they call it the benefit account value. Okay, so for example, if the benefit account value grew to 100,000 during the 10 years of deferral, and you're age 60 turning on income, your payout amount would be factored by multiplying the payout rate, 3.85% in this example, multiplied by the $100,000 in the benefit account value. And so your annual payment would be $3,850, 3.85% of 100,000. On each income payment anniversary, the annual income payment amount will be increased by an amount equal to the current annual income payment multiplied by the benefit account value growth rate. So we're going to break that down here just a brief moment when we look at the illustration. So you'll see there's a lot of redundancies in this brochure. They talk about the free withdrawal several times, so I'm not going to spend too much time there. But again, just to reiterate, you can access up to 10% free withdrawals anytime after the first contract year, and that would be at 10% of the total premiums paid. The enhanced death benefit rider, this is a no-fee rider automatically included with the contract and includes both a qualified nursing care and terminal illness benefit. The enhanced benefits, that doubling of the income in the event you had a need for long-term care or qualified nursing care. It'd be doubled for single life, or 150% of the income amount if you were filing for joint. Death benefit proceeds are paid to the surviving joint owner. If there is no surviving joint owner, the death benefit is paid to the named beneficiaries with no surrender charges, generally paid in a lump sum. Other payment options are also available. And then, of course, this product is unique because it offers an enhanced death benefit option. Beneficiaries may elect to receive the enhanced death benefit in place of the death benefit provided under the base contract. Beneficiaries may choose to take a single lump sum payment or a series of equal payments over a period of 5 years. The lump sum payment is the benefit account value at the date of death multiplied by a 75% death benefit payout percentage. So whatever the benefit account value is at the date of death, they'll take that amount, multiply it by 75%, and then that will equal the lump sum payment for the enhanced death benefit. In this type of annuity, the benefit account value will most oftentimes always be higher than the general base contract value, okay? Because of the benefits of the multipliers and things that are applying to that benefit account value. So the benefit account value will always be higher than the contract value. We'll be showing you in a brief moment on a illustration. Series of payments over 5 years. So here's how you can get more, or here's how your beneficiaries rather can get more payment via the enhanced death benefit. And that is if they elect to receive the payment over a period of 5 years, the benefit account value at the date of death will then be multiplied by 100%, and that will determine how much will be paid over 5 years. So you get a 25% bump versus the initial, the lump sum payment. If you elect to take the payment over 5 years, you'll receive 100% of the benefit account value versus 75% in the lump sum option. Okay. All right. Not going to really go through too much here. These are just the current rates, which we're going to be looking at this here in a moment based on our back-tested performance analysis. So I'm not going to spend too much time there. Here's where we'll cover the benefits of the lifetime income benefit rider with well-being benefit, enhanced death benefit. The benefit account value bonus at the time of this recording is 25%. And let me just double check that, make sure that that's still true at this time. Bear with me here. Okay, so yeah, that looks to be true. Again, rates and offers can change from time to time, so it's best to check with your financial professional or with me directly. But at the time of this review, which again, rates are subject to change, but the benefit account value bonus percentage is 25%. Benefit account value multiplier is 150%. And the benefit account value will grow for the life of the contract. Income payments may begin after 10 years of deferral and 10-year enhanced income waiting period. 200% enhanced income payment factor for single life, 150% for joint, and up to 5-year enhanced lifetime income benefit period. And that is just what we covered there. If you defer the death benefit for 5 years, you'll receive 100% of the enhanced death benefit option according to the current value of the benefit account value. Okay, so let's jump in. Just want to make sure there's nothing else that I should be covering here. American Equity, if you haven't done your research on them yet, great company. Last year ranked third overall for customer satisfaction according to J.D. Power and Associates for life insurance companies. The only companies ahead of them were Nationwide and New York Life. So very great company. I enjoy working with them. They treat our clients fantastic. They're very personable. As soon as you call, someone answers, and it's an American person in the U.S. No offense to any overseas customer service, but it just makes things a lot easier when you can speak with somebody here in the U.S., at least in my opinion. Okay, so let's go ahead and take a look now at our software, where we're going to take a look specifically at what we call the back-tested performance analysis. Now, again, I must make the disclaimer that prior performance is not always the best indicator for a future performance. But at the end of the day, none of us have a crystal ball to know what the future holds. But we can, generally speaking, get some education and an idea on how things performed in the past by analyzing the data that we have available using our tools. So here we're looking at the Estate Shield 10 and the specific index crediting strategies that are available. You're going to see a couple things over here to the right. First, we're going to notice the 10, 15, and 20-year columns. Those are referencing the back-tested performance periods. So we're going to be looking back over the last 10 years, 15, and 20 years, and then taking a look at the specific index crediting strategy, including the underlying indice or index, to see how it would have potentially performed if we owned this contract with everything created equal today in regards to the offerings of the contract, and looking back over the last 10 or 15 or 20 years and getting an idea of what it could have potentially performed at. Now, again, it's all hypothetical in nature, so none of these things are guaranteed, but it still gives us an idea, a snapshot of what this could have potentially done and what it could potentially do moving forward if markets behaved in a similar fashion. So these are all listed in chronological order, starting with the highest average annualized rate of return during the last 10-year column. That last 10 years is from December 31st of 2010 to December 31st of 2020. And a couple things you're going to notice in these columns is the larger black numbers. Those are the average annualized rates of return. And then in addition, our software takes it a step further and analyzes that data to determine the best 10-year performance period over the last 20 years and the worst 10-year performance period over the last 20 years. So we'll see during the last 10 years, the average annualized credited interest, or at least the average annualized rate of return on this specific index strategy would have been 5.02%. And then the best 10-year performance over the last 20 years would have been from December 30th of 2002 to December 30th of 2012. And that would have been 6.35% per year. And then conversely there, we'll see the worst 10 years over the last 20 years. That worst 10-year period was from December 30th of 2005 to December 30th of 2015, and the performance would have been at 4.68% annualized rate of return. Now, the specific index strategy that we're looking at to get those numbers is the 2-year SG Global Sentiment point-to-point with the participation rate. Now, if you're not familiar with what all of that means, 2 years indicates the crediting period. So the crediting period would start on the issue date of your annuity contract and then have an anniversary 2 years from that date. And point to point is referring to the starting point or the starting index value for that SG Global Sentiment Index. You'll receive communication when your annuity is issued that the starting index value is such and such. And then upon your anniversary for that first 2 year period, you would receive communication on the ending value or the ending point of that index, in this case, the SG Global Sentiment. If the ending point is higher than the starting point, then that indicates you had positive growth for that 2 year period. They'll take that positive growth, let's say it was 10% for that index, and then multiply that 10% growth by the participation rate. In this case, it's 70%. And then 70% multiplied by that growth would equal your net interest credit to your contract value. So for example, if the SG Global Sentiment went up 10% during that 2 year period of time, and you multiply 10% by 70% participation, that would equal a 7% interest credit. Simple. Participation rate just indicates of the index's performance, how much do you participate in as the investor or the consumer? Okay. The participation rates, the rule of thumb there is the longer crediting period, generally speaking, then the higher the participation rate will be. So if we looked at a 1 year crediting period, it would most oftentimes in most products, most indexed annuities, be less. The participation rate would be less than a 2 year point to point. Simple reasoning for that is because, not to get too far in the weeds, but the insurance companies, the way they make these growth potentials work, the opportunity to have these types of interest credited, is they're buying options on these specific index strategies. And if they have a 2 year period of time, they just have a larger window to make those options strike and make them work. So essentially giving them a larger window of opportunity to provide index interest credits. Okay. So if they have a 1 year period of time, they have less time. Simple as that. So that basically is the first index that would come in based on 10 years. Performing number one during the back test is the 2-year SG Global Sentiment with a participation rate. Over the last 15 years, that same index strategy would have performed at 4.27% average annualized credited interest. And coming in second is the 2-year Credit Suisse Tech Edge point-to-point with a participation rate. Again, it's a 2-year strategy with a 70% participation. We'll see over the last 10 years, 4.93% average annualized rate of return, 5.12 for the best 10-year period over the last 20 years, and 2.72 for the worst 10 years over the last 20 years. 4.03% at 15 years and 3.86% at 20. Coming in third is the 2-year Bank of America Destinations point-to-point participation rate. Again, a 70% participation rate. 3.96%, 4.4 on the best 10, 3.81 on the worst 10, 3.69 over the last 15. And then we'll start to see the 1-year strategies come into play. We'll have the 1-year SG Global Sentiment here as a prime example. The 1 year has a 50% participation, bringing the average annualized rate of return over the last 10 at 3.56, highest 10 at 4.52, lowest 10 at 3.36, and average over the last 15 at 3.41. Credit Suisse Tech Edge comes in at second for the 1 year, again 50%, 3.49, 3.63 on the best 10, 2% on the worst 10, 3.22 over the 15, and 2.74 over the 20. And then followed by Bank of America Destinations at 2.85 over the last 10, 3.21. Best 10, 2.71. Worst 10, 2.71 over the last 15. And then last but not least, the S&P 500 point-to-point with the monthly sum cap. The cap is a 1.2%. So if you're not familiar with a cap, it just indicates how high on each given month. In this case, it's a monthly sum strategy. They're going to look at the S&P point-to-point on a monthly basis. And the most you can earn in any given month would be 1.2%. And they're going to add up the average interest credits over the 12-month period to determine what your interest would be. Using that strategy, it's a 2.29% average over the last 10. That also indicates the best 10, lowest 10, 0.89. 1.98 over the last 15, 1.83 over the last 20. And then I guess this is last but not least, the 2-year S&P Dividend Aristocrats coming in using a cap strategy at 5.5% per crediting period, 2.2 over the last 10, 2.4 best 10, 2.2 worst 10. I am an advocate for high participation rate strategies with no caps and no spreads. So all of these cap strategies, I personally would not recommend or advise a client to partake in those. My clients would be looking at these, a blend most oftentimes of the 2-year strategies and the 1-year strategies to give us some diversification across the indexes and the crediting periods. Just like any other investment, you can diversify your funds in the annuity itself, and it's key to ensure the annuity that you're considering offers at least 2, preferably 3 strong performing index crediting strategies. Now, when I say strong, I'm just referring to, being able to determine in some capacity what the performance potential could be, whether you're looking at back tested periods or what have you. But we want to make sure that it offers at least 2, preferably 3 strong index crediting strategies to allow us to break up the allocation of funds to those specific strategies. The reason for that is, you're signing a commitment for 10 years, and you want to at least ensure that you have some flexibility and some optionality moving forward, and that your eggs aren't all in one basket and being in one index. So the more index strategies you have that have a strong back-tested performance, at least, that's preferable. So if you're looking at an annuity that only offers one strong strategy when looking at a back test, and it may offer some others, but they don't perform quite as well as the one, I just wouldn't advise you to even consider that one. You have to have at least two, preferably three. In this case, the Estate Shield 10 meets my requirement in my philosophies regarding index crediting strategies and offers a nice blend of 2 years and 1 years that are attractive. Now, these rates of return that we just looked at, these are particular to just the index crediting strategies themselves when factoring in the participation rates, caps, and or spreads. And that credited interest would be going towards your contract value portion of the annuity. This is not indicating the benefits account value that, remember, has a multiplier, okay, of 150% to the benefit account value. So if you're looking at this annuity, you have to be sure that you're factoring in the 150% to these numbers. So for example, and we're going to look at the illustration here in just a few minutes. For example, if we received an average annualized rate of return on the 2-year global sentiment index strategy, and you take that 5% and multiply it by the 150% multiplier, the net credit that would be applied to the benefit account value, that is what's being used to determine your lifetime income and or enhanced death benefit values, the net credit that would be going over to that benefit account value bucket would actually be 7.5%. So if you take that 5% average net interest credit, multiply it by the 150% multiplier, the benefit account value would be growing quicker because it's receiving the multiplier. In this case, in that example, the benefit account value would be receiving 7.5%, while the regular general base contract value would receive that 5%. So you're going to have independent account values, one that's called a contract value, the other that's called benefit account value. They grow independently based on the offers of the contract. Okay, so the best way to look at that, and we're going to do that right now, would be to take a look at our illustration software. So we're going to look at a male age 60 in the state of Florida, putting $100,000 in non-qualified dollars into this account. We're also going to diversify those funds and maybe put 50% in the top two strategies, in this case, the 2-year global sentiment and the 2-year Credit Suisse Tech Edge. Now, you can, and I advise, and most oftentimes, to diversify even more than this, especially if there's at least 3 strong crediting strategies. In this case, there are. But for this example, we're just going to put 50 and 50 to make it easy. And we're going to say he's turning on income when he turns 70. So a male at 60 turning on income after 10 years of deferral, which is the waiting period requirement. Turning income on at age 70 when he plans to turn on his Social Security in this example. Okay. So here's the guaranteed values of the contract, again, showing the $100,000 premiums coming in. And then you're going to see the green column here is your account value, or what I refer to as contract value. That's your base account value, base contract value. 100,000 going in, 100,000 going into the contract value. Now, remember the bonus that we have on this product. Now, I do need to make a correction. The bonus when this product initially launched, which was just a short time ago, was 25%, but it was a limited window of time that you could take advantage of the 25%. The bonus has been reduced to 20% on this product, and I believe that's where it's going to stay moving forward. The 25% was more of a initial offering for getting this product out on the market. So please, understand the brochure that we reviewed did say 20%, 25%. That was a brochure that was dated back to the initial launch of this product, which was just a short few months ago. But currently 20%, and it's right in line with the other competitive products in this space that allow for increasing income potential. So you'll see that 20% bonus being applied here to the income base. So we'll see that 100,000 growing to 120,000 on the income benefit base. Now, the income benefit base is just a general term in this software. That's what we've been referring to as the benefit account value. Benefits account value. So your benefits account value, which is used to determine your income stream moving forward, is growing by that 20% bonus, and then growing. If there were interest credits, they'd be also coming in. But in this case, for the guaranteed portion of this illustration, at this time, it's assuming there's no interest coming in because that's not guaranteed. It's based on how the indexes perform, the index strategies perform. But what we are seeing is the base level of guaranteed income that it would be there even if the interest was never credited. If there was no index performance, there's no positive index crediting performance, and you had 0% every year for the 10 years of deferral, you still have a foundation of income that's guaranteed in the contract no matter what. And that amount would be $6,420. Now, remember, we reviewed the payout factors, or what's also referred to as a lifetime withdrawal rate, and that's based on the age at the time you elect to turn on the income. Since this person would be 70, the lifetime withdrawal rate would be 5.35%. If they turned it on any time before that, let's say they turned it on at 65, the payout rate would have only been 4.85%. If they turned it on at 62, it would have been 3.85. But remember, they wouldn't have had that option anyways, because they are required to defer for 10 years in this particular product. Now, the income amount, $6,420, that's easy to formulate there by taking the income benefits account value multiplied by the lifetime withdrawal rate, and that'll equal that lifetime withdrawal amount on an annual basis. The other column you see here is the enhanced lifetime withdrawal. That's that doubler, or the 200% multiplier that's applied to the initial lifetime withdrawal guaranteed amount. In the event you have a need for nursing home care or confined care, that 200% multiplier will apply to that $6,420, essentially doubling it to $12,840 and paying that amount for up to 5 years. In the event you had a need for confined care. After 5 years, it would default back to the $6,420 in this example. Okay, so moving on. So we understand the guaranteed portions. That's just indicating that growth is not guaranteed. It's all based on the index crediting strategy performance, but there is a guaranteed minimum income amount regardless if there was interest credited or not. Now here what we're looking at are the hypothetical values using current rates. And what we're doing is taking a look at the most recent 10-year calendar period, getting those annual rates of return, and then applying them into this contract illustration moving forward to see, how this annuity could potentially perform moving forward if markets behave similarly. So if we look at this illustration, we have 100,000 going in, again, 100,000 being credited to your account value, and then that same 20% one-time bonus on the benefits account value being applied. Again, I'm referring to the income-based column when I say benefits account value. Now, one interesting difference here is that now we have interest being credited on a 2-year basis because we allocated 100% of our monies to the 2-year crediting strategies. So you'll see after the first 2 years, we have a 13.12% interest credit that's applied. You'll see it being applied here on the account value column, as well as on the benefits account value column. Now, you'll see the benefits account value column at 143,608 is significantly larger than the account value column. And if you remember, the reason for that is because we have that 20% bonus that was applied. And then when that 13.12% interest credit comes into the account, that gets multiplied by the benefit account value multiplier of 150%. Therefore, growing the benefit account value to 143,608. So when you have a 2-year crediting strategy, you'll notice that every other year you'll have a 0. That's just because your credited interest doesn't actually get applied to the account until the end of the 2-year crediting strategy. At the end of contract year 4, we'll see 10.83% interest was credited, bringing that account value to $125,336, and then growing that benefit account value, which is used for lifetime income calculations, to $166,941. Again, that 10.83 was then multiplied by the benefit account value multiplier of 150%, and that's what grew that income benefit account value to $166,900. Using that same scenario, but fast forwarding it to the end of 10 years, we'll see that, every 2 years there was interest credited in some fashion, growing the account value to as high as $162,459 at the end of that 10th year, and then growing the benefit account value for lifetime income to $244,016. Now, if you take that, since we're illustrating the income to start at age 70 after 10 years of deferral, starting in contract year 11, they're going to take that $244,16 in the benefit account value bucket, multiply it by the 5.35% lifetime withdrawal percentage, and that's going to equal an income stream for life of $13,055 on an annual basis. You'll see the enhanced income benefit or lifetime withdrawal benefit is $26,110 for nursing home or confined care needs. And then also on the death benefit column, which will be at $183,12, but here's where you really want to look. Remember, that's including if they take a lump sum death benefit, they get 75% of the benefit account value. Okay, in this case, 75% of $244,16 would be $183,12. And then coming over to the far right, let me make this a little bit smaller so we can fit it all in. If they elect to take the death benefit over a period of 5 years, they would receive 100% of the benefit account value over 5 years. So in this case, $244,16 matches the benefit account value because they get 100% of the benefit account value as long as they agree to take that payment over 5 years. Now, remember we talked about increasing income. That's where this product is really unique, and it's really where it compares with other products on the market like the Allianz Benefit Control, the Athene Agility, the Global Atlantic Choice Income, the AIG Power Index Protector, the several of these annuities out there that are very competitive with one another. But here's where it really shines, is in the increasing income opportunity. Okay. So once income in this example was turned on at age 70 of $13,055, okay, we'll see that another interest credit comes in, again, 13.12 in the 12th year of the contract. And we'll see that the income receives an increase or a bump because of that interest coming over. So if you take that interest credit, you'll see that it carries over to the benefit account value. It grows it to $245,000. They take that $245,089, multiply it by the 5.35, and that equals your new locked in lifetime income payment moving forward. Anytime an interest credit comes in from the index strategies, it still gets applied over to the income benefit column, while in addition being applied as well to the income amount. So for example, you'll see the $15,623 after a 10.83% interest credit. That will grow the income to $18,162, so on and so forth. So in this example, when we're just looking at the most recent 10-year performance and then projecting them moving forward over a 30-year period of time, you'll see that by age 80, the 21st year of the contract, the income is increased on an annual basis to $53,000 $93. So that's where the product is unique. That's where the opportunities are. Some people look at this as a potential inflation hedge. Some people are looking at it as just a way to increase their lifetime paychecks without taking market risk to do so. It's a unique feature, unique structure in this annuity that gives it the opportunity for that to occur. It's not guaranteed to occur, but it can occur, if the index crediting strategies perform well moving forward. I always say to be conservative. At the end of the day, you have to ask yourself, would you still be happy if these income values performed at half of the interest credit? So to be conservative, and if you can answer yes to that, then anything above that is just icing on the cake. The key thing to understand is that these are insurance products made to put guarantees on a portion of your retirement portfolio, specifically to protect a portion from principal losses due to market volatility, as well as giving them safe growth potential and guaranteed lifetime income. So appreciate you tuning in. I hope that this has added some value to your annuity search. Definitely a good product here in the Estate Shield 10 offered by American Equity. If you'd like to take a deeper dive into this particular annuity, or maybe you'd like to do a side-by-side comparison with one you already own or one you're looking at potentially buying, and you'd like to see if this one or a different one is better for your particular situation, and you'd like to work with me directly, I work with clients in all 50 states. I'd be very grateful for the opportunity to work with you. You can do that by going to annuityassociation.com. Right there on the main page, click the green button to request your free report, and I will you'll be taken to a series of questions. One of those being, would you like to be contacted by an advisor? Simply answer yes, and I will personally reach out to you in a timely fashion to see how we can get together and how I can help point you in the right direction. So if you got some value, give us a thumbs up on YouTube, or like and share this on Facebook or LinkedIn, wherever you saw this video. That would be greatly appreciated. It helps our videos get ranked for other people searching for information such as this. So thanks again for tuning in. This is Jeremiah Conjure from Annuity Association signing off. Hope everybody has a wonderful end of their day. Take care of one another. So long.